We're going to look at Crown Castle International, which is a REIT. This company owns and leases cellular towers and other equipment for wireless companies to operate. And what I do in my videos is I try to figure out the value of a stock using prior financial information. And I also look at the financial ratios of the company and compare them with similar companies. Let's get started with the model. This company has a market cap of $70.4 billion. So that's a value according to the stock market. And they're trading at $168.80. So that's how much one share of stock costs. And now I'm going to pull their free cash flow. And the way you value a company is you estimate the future free cash flow and discount that back to today. We also need the net income, which is the profit and loss for the company. And that's on the income statement. And I'm going to put 4 years of that into the model. And the model does all the calculations. It's all set up. And we also need the revenue, which are the sales for the company. And we want to take a look at the numbers to make sure they look okay. All the numbers look fairly consistent and positive, which is a good sign. And their net profit margins have increased every year. So net profit margins are net income over revenue. It's how well the company converts revenue into net income. So they're becoming more efficient of a company each year. So that's a good sign. Let's look at the capital structure of the business. Let's figure out the interest expense. That's the interest they pay on their debt. That's $662 million. And let's see how much debt they have. We'll go to the balance sheet. We'll go to the liability section. Current debt of $111 million. That's debt due within 12 months. Non-current debt of $19 million. That's debt due after 12 months. REITs don't pay taxes because they have to pay out at least 90% of their profits in the form of dividends. And the investors who receive the dividends are paying taxes on them. Let's figure out the cost of equity. We need the beta, and the beta is how volatile the stock is relative to the entire market. And this has a really low beta of 0.36, so the stock moves roughly 1/3 of what the market moves. Let's go back to the balance sheet and get their current assets. We need this for when we look at the current ratio later. And current assets are mainly cash, accounts receivables, and inventory. These are the assets that are used to run a company's day-to-day business. $1.2 billion. Current liabilities are debts and payables that are due within 12 months, and that's $1.4 billion. Let's get the equity. That's $11.8 billion. That's assets minus liabilities. We need the equity because that's part of the ratio for ROE and the price to book ratio. Let's pull the EBIT. That's earnings before interest and taxes. That's $1.6 billion. It's called operating income on the income statement. And we need this number for the interest coverage ratio later. Let's look at the capital structure. The cost of debt is 3.4%. That's just the interest rate they pay on their debt. And the weight of debt is 62%. The cost of equity is 5.1%, and the weight of equity is 38%. So the weighted average cost of capital is 4%. It's a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $75 billion. We divide that by 407 million shares. And we get a calculated intrinsic stock price of $181. It's trading at $169. So it's trading at a 7% discount. So it's a buy according to the model. Let's see what Simply Wall Street values the company at. They value them a little higher at $184. So they're also saying the company is a buy. Let's look at the historical stock price to see where it's been trading. Stock was pretty steady for a couple of years, but it's been in an incline lately. And it looks like it's almost at its peak at 171. So let's look at the financial ratios of the company. Really high price to earnings ratio, that's price to stock over earnings per share. They have a really high price to sales ratio of 12.2, that's price to stock over sales per share. And you want a lower price to sales and price to earnings. Also a lower price to book as well. And the price to book is a bit high at 5.9. Current ratio 0.9, so they cannot cover their current liabilities. So that is a little concern, especially now. I know most companies are struggling financially, so if they continue to struggle, they're going to need to take on more debt. And they're already at 62% debt. 7% ROE, that's income over equity, and 2.4 interest coverage ratio. So they can cover their interest payments 2.5 times, which isn't terrible, but it isn't much of a cushion. The best way to look at ratios is to compare them to similar companies. So a lot of analysts use the funds from operation calculation to look at REITs instead of the traditional ratios. And funds from operations is net income plus depreciation plus amortization minus gain on sales of real estate. The reason you add depreciation is because most assets decrease in value over time. That is why companies have to report depreciation on their income statement and balance sheet each year and take a loss on an asset, because the value of most assets keeps going down every year. But REITs own property which generally increases over time, not decreases over time like a car. That is why they add back depreciation to give a clearer picture of the company. The funds from operations per share for AMT is $7.88. For Crown, it's $5.69. For Hannon Armstrong, it's 57 cents. And for Power REIT, it's 63 cents. So in terms of funds from operations per share, AMT is obviously doing the best, but they're the biggest company by far. They're 108 billion market cap. CCI is a pretty big company at 70 billion market cap, but these other two companies are just really tiny, especially Power REIT. CCI has a worse PE than the average REIT. They have a better price of sales, a better price to book. They're under 1 in current ratio, like American Tower, so that's not good. The ROE is worse than the average. Their debt is a little better than the average. They're all a little leveraged, especially American Tower. And Crown Castle is a pretty big company in terms of market cap, $70 billion. Analyzing REITs can be a little more challenging, but as I do more videos, I think my models will get more and more robust. Thanks for watching the video. Please leave a comment.